Welcome to this edition of What the F Just Happened with Dave Kranzler and myself, Eric Dubin. This is July 6th, and we've had some fantastic trading in gold with what looks like, quite likely, a bottom being put in. Seasonally, we've had 3 Julys in a row each year where there has been action in the markets that suggest, in the very least, an intermediate turn in the markets. I mean, we have experienced the precious metals having the snot kicked out of it every December period and the tail end of years, but we've seen some significant turns in July. That's a seasonal pattern we've seen a lot. We see Asia buying, and we'll talk about some interesting things that I've noticed with particular coin stores and what that may mean in terms of the psychology of the North American market. Dave, what's up? What are you seeing? What do you think's going on with precious metals in this interesting week, holiday week, thin trading, and maybe the cartel was away for a while and not as attentive to their manipulation efforts?
Well, all the things that I look at indicate that the gold and silver have likely bottomed. I'm not saying that. I think on Tuesday earlier this week, I think we hit 1239 intraday on the front month gold contract. And so where are we right now? 1255 or something? I'm not going to go and say, with all the manipulation, I'm not going to represent that, that's the bottom and we're headed higher here. But a lot of the related indicators like the commitment of traders and chart technicals and sentiment are telling me that we're at least in the bottoming process, if not having, already bottomed. I think we're up, 1256. So we're up essentially $17 from the low that was hit earlier this week. And an interesting thing, I did a full-blown analysis of last Friday's commitment of traders report. I did it for gold, not for silver, because gold is the interesting one. And in my mining stock journal, and without giving too much of it away, essentially the managed money category, which is the hedge funds, are slightly net short gold contracts. And there's only been one other time, if you go all the way back to 2006, and I believe if you go all the way back to when this bull market originally started, although they didn't disaggregate the reports, I think, until 2004, maybe 2006, to break out the large speculators into hedge funds, and they call it other reportables. But there's only been 2 times when the hedge funds were net short, and the first time was in late 2015, and obviously everyone who's listening to this show knows what happened then. And then this latest commitment of traders report shows that they were slightly net short. We'll find out later today when the commitment of traders report is released, but I would suspect, the cutoff date is Tuesday earlier this week. I would suspect that the hedge funds probably were even more net short as of the latest cut report. What happens is the banks start, technically setting up the market to make it look bearish. The hedge fund algos chase the market lower. They puke their longs. They chase it lower by going short, and that's usually when we bottom. And I think that's where we are right now.
From a technical point of view, the picture that's painted by forces that seek to, shape how investors, broadly speaking, perceive the marketplace, perceive gold and silver, always looks the worst right at the very bottom. Technical analysts almost always have an inverse understanding of the psychology of what goes on in the precious metals markets as opposed to applying technical analysis in any other market because of the degree of manipulation that happens in the precious metals market. We are clipping the lows that we saw in gold last December, when December marked the bottom. And people looking at the markets now have very often taken the perspective that there's no support. Things are going to get even worse as the Fed normalizes their balance sheet, but they're not seeing the bigger picture, and that is how weak the economy truly is, how the political outlook looks horrible. We have a midterm election cycle coming up, and anti-Trumpers are vociferous in their opposition to him, and Trump's base is falling apart, and the trade war that is brewing, the frictions that we see on our political front are going to collide with what we already have been talking about in all of these shows about how the economic picture is not as rosy as the mainstream is painting. And I think all of these things in the context of a 10-year-long fake recovery in our economy, very long in the tooth, and that this is the year where people are beginning to come out. And we made the argument that we've lived in a stealth bull market all along for the last 2 years in precious metals. And even though we were hit pretty hard, we're still at support levels that match up a trend line in gold that ended at the end of 2015, and we bounced on July 3rd this week, in part because the smart money sees all of this. If we look at the miners, they're stable. If you look at GDX over the last 2 years, GDX has barely dipped below $21 per share in 2 full years. It's been flying all over the place. Yes, there's a lot of volatility, but that reflects a stealth bull market. We had a huge move in 2016 as people ran into the miners. But now miners are just treading water in the broader indices, and a lot of miners are doing very well.
I'll tell you, the GDX chart is pretty stunning because if you go back to the beginning of 2017, it hit a bottom then after it had a massive run up during 2016, and it sold off and hit a bottom down around 19. And I mean, it almost looks like a straight line going across the rest of my screen. A lot of technical analysts like to look at Bollinger Bands, and as they get tighter and tighter, it's said that something's getting ready to make a big move either way. And
the longer the duration of moving in a horizontal range means the bigger the move when you get out.
I mean, this looks
always speak of.
Right. This looks like the GDX is almost straight lined. It basically has straight lines since the beginning of 2018. And so, you got to really squint to see the gap between the upper and lower Bollinger Band.
When bear markets process over years and flush out the holders who once were bullish and then get slaughtered, that's the pattern you see. A long duration horizontal move of just complete and utter total boredom. The people that were in and got slaughtered are gone. They're gored. And, initially you don't have a long line of people interested in reacquiring the asset or the asset class in this case. And you end up just getting a kind of washing out and base building and whatnot. And that is completely congruent with what we've seen with gold actually being in a stealth bull market and under accumulation over the same number of couple of years and everyone not seeing it or not caring about it, better said. People recognize the price, but they just don't recognize what it means and how it'll change when the economy rolls over and the standard equity market takes a dive. We have valuations in the tech sector that are reminiscent of year 2000. We have an everything bubble now. Bond market still is going to correct. The economy is going to roll over from all of the fake asset priming attempt to create aggregate demand in the economy based on nothing but excessive generation of credit and creating multiple bubbles everywhere. The housing market, student loan bubble, the excess consumer debt bubble. All of those things we can see deflating, things that we've pointed to in shows before. Restaurant sale trends, etc.
That's right. Eric, are you bored by the mining stocks right now?
Oh, hell no. I'm licking my chops. I wish I had more capital.
I know. I'm actually...
We're going to see a big move.
I think this is a really exciting time to have cash to put to work in the mining stocks. And there's a lot of junior mining stocks that are extraordinarily cheap relative to what I would just, for lack of a better term, call the intrinsic value of the company's assets, whether it's deposits in the ground or other various investments that some of these junior mining companies have. I mean, these things are extraordinarily cheap. And you could even say the optionality of a lot of these mining stocks are extraordinarily cheap relative to the properties that they're exploring and the mineralization that they're finding on these properties. So, and I discussed several of these in my mining stock journal. There's one company that bought some land up in Canada thinking they were going to explore for silver, and they ended up hitting some very rich cobalt mineralization, and they're going to spin that asset off to shareholders, and it's going to leave them with a massive silver property that they're exploring in of all places, Montana. And that silver property alone could be a home run. So it's just, there's plenty of examples like that in the junior mining space where, I mean, these companies are trading for mere fractions of what they're potentially worth right now.
For investors looking to speculate and benefit from that, building a portfolio of that, spreading one's risk around, picking good miners. I mean, the trick in mining share investing is to have a diversified portfolio, but focused on the really best of the best as far as their prospects are concerned. Sentiment-wise in the sector, I'm always most excited when people hate my calling a bottom more than not. People now have a view that the sector is just going to roll over, and the sentiment is on par with the worst I've ever seen.
Well, no, the ultimate signal was Dennis Gartman. He threw in the towel on all of his gold positions a week ago. This is a quote from his newsletter.
And he covered his shorts on the general equity.
Yeah, he got stuffed out of his short position. So I was back in adding home builder puts this morning, and I probably will add some more right before the market closes. He says, as for gold, we have clearly held on far, far, far too long to having owned gold. Clearly, we've been wrong to have erred bullishly of gold in any fashion whatsoever. We shall have no choice henceforth but to look upon any bounces that we get as opportunities into which to sell, if for no other reason than to clear our positions and clear our minds, for we are losing both real and mental capital by remaining long of gold in any fashion. Well, first of all, for him, it's just mental capital because he doesn't commit money to the market. He just has paper positions.
It's his retirement account, remember, Dave?
No, he blew up the 2 ETFs that he had that were based on his calls. So
yes, on other people's
right. I mean, there's a reason why we call him Wrong Way Dennis.
Right. Well, that gets back to what we were speaking about with technical analysts having a tendency, traditional ones at least, of getting the interpretation of technical signals applied to the precious metal space completely ass backwards because of not understanding the true fundamentals and the way in which that interlaces with manipulation. And Dennis is the archetypal screw-up when it comes to technical analysts trying to make sense of the gold market.
Yep, I couldn't agree more. In fact, my fund partner is a huge technician. I mean, he loves to look at pointing fingers. He loves to look at, regular charts. And he kind of lives and dies by technical analysis. And it's probably around 2005 or 2006. I just said to him, look, you can't apply technical analysis to the precious metal sector because of the extreme manipulation. And if you look at what happens whenever the market looks technically like it couldn't get any more bearish, that's when you want to buy it. The precious metals do the opposite of what the technicals suggest they should do. And people just do not understand that. And you really can't.
Yeah, and technical analysis always is an art. I mean, it's an art, not a science. And being able to actually flip it and understand when and where the converse interpretation of traditional understanding of technical analysis applied to the gold market works is something you figured out because you follow the market close enough and you also understand technical analysis. A lot of people who have looked at the gold space have hated anyone speaking about technical analysis because most of the technical analysts always get it wrong.
That's right. And the thing is, I mean, there's room for technical analysis in the precious metal sector, but you also have to include other variables. Like you got to look at sentiment. Right now, the Holbert Gold Stock Newsletter Index is negative. It's been negative for like the last 8 days, and it's rare when it goes negative for that long a stretch. And it's usually a very, very bullish indicator. That Holbert Sentiment Index is a fantastic contrarian signal. You also have to incorporate analysis of the Commitment of Traders report and how to apply that. And guess what? On the eve of 4th of July, there was a massive block of gold that traded on the London PM fix. There were huge offers put out trying to manipulate the market lower, and buyers swallowed those. So that tells me that there's large demand for physical gold going on right now in Europe. I mean, obviously it goes right. Obviously it may be UK based gold demand, but it gets shipped to refineries in Switzerland, and then from there it gets shipped to India or China.
And this is the period where you see the stocking up of the inventory channel for Diwali and other, wedding season festivals and stuff in India. And China's been buying, and Chinese retail buyers are now stepping in because they're worried about the Chinese yuan being devalued because of the economic trouble that's going on in China, where they cannot increase their credit all that much to try to boost their economy. So all of a sudden, policymakers are now looking at the option of trying to prime exports by devaluing their currency. All these things are intertwining with what's going on politically and economically in the United States. I mentioned on Dave Janda's show last Sunday something pretty interesting that I've noticed in my neck of the woods. Southern Oregon is a very libertarian-minded, very open-minded community when it comes to people and their understanding of sound money principles. To prove that point, during the last two presidential elections where Ron Paul was running as a candidate, he was getting 20-30% of houses with yard signs in front of their place. I mean, that tells you that Southern Oregon is not a typical place. And when it comes to, the way people think about politics, a lot of libertarian-minded people here. And the coin stores here that I know have seen a very significant shift in what has been going on with their customer base. For over a year, second largest coin store in Medford, Oregon, was seeing 20 customers come in selling ounces, 20 ounces being sold by customers and only 1 ounce being purchased from the coin store. And that was going on for, on average, about a year. All of a sudden, it's now 2 sales, 2 ounces for every 1 purchase. And I think that that's significant. I mean, I've had experience with folks over at Silver Doctors and ST Bullion, and they're the 4th largest bullion dealer now nationwide in the United States. And their sales reflects what is, going on in the psychology of the overall North American market. And one of the missing legs from the precious metals market truly rebooting is complete absence of the retail buyer in North America. I think what we're seeing now is actually people coming in, recognizing seasonal trends, recognizing the political backdrop, the economy being weak, the stock market long in the tooth and high valuations, and the educated segment of the public that actually cares to reach and dig into their pockets and buy some long positions for physical precious metal. That retail buyer beginning to get woken up. Where you'd see them wake up first is exactly where I live, given the psychographic background of people who live here. I see the big picture global macro trends of Asia, and I see right down into my own little neck of the woods that tell me there's something shifting in psychology, and the timing is perfect.
I don't have much to add to that, and I couldn't agree with you more. Eric, before we wrap up, I just wanted to mention, because we did not get around to discussing the economy, but based on all the data that I look at, the economy is heading south pretty quickly, and I think that does tie into this idea that gold is bottomed, and we're going to start to see capital flow out of the stock market and look for alternative, quote unquote, safe haven assets. And I think gold and silver and the mining stocks will be a big beneficiary of that. But also, you can make a lot of money taking a bearish view of stocks. And in my short sellers journal, I've been writing a lot over the last few months about the home builders. And most people don't realize this because it doesn't get reported on CNBC or Fox Business or the Wall Street Journal. But the home builder stocks are technically in a bear market. The Dow Jones Home Construction Index is down 21% from the 52-week high that it hit in January. And I've been making a lot of money, and my subscribers have been making a lot of money on my home builder short sell ideas, which includes shorting stocks outright and also buying puts or selling calls on home builders. So my next issue is going to be out on Sunday, and I'll have another couple pages in there of housing market analysis plus trading ideas on home builder stocks.
So much of our market move has been led by just a few stocks. It's been a very thin bull market, and that's another reason why it's an illusion. I mean, some 20% of the S&P 500 has been in a bear market. There's a lot of opportunity for on the short side. And Dave's letters are fantastic. I highly recommend them.
No, I appreciate that.
This has been another edition of What the F Just Happened. We're recording this on Friday, July 6th, and markets are kind of placid as we go into a Friday, and next week will be very telling. But we believe that at the very least, we're in a bottoming process and likely are going to follow seasonal patterns and bottoms. So stay tuned. We'll be back next week, and thanks for listening. This show is brought to you in part by Wall Street from Main Street. You can click on the YouTube link to pull up other videos that Jason Barak and his team produce. And you can follow Dave's work and check out his 2 newsletters at investmentresearchdynamics.com. This is Eric Dubin, and you can find what I post on Facebook at facebook.com/Eric Dubin. Thanks for listening. We'll catch you next time.